Hello there. We are from Group 13, consists member of Mohammad Mirza Muhammad Fauzi, Mohammad Rosmin bin Rosli, Donnell Aaron Deblin, Abraham Emil Peter. Very good morning. My name is Mohammad Mirza bin Muhammad Fauzi. Today I'm gonna explain about job order costing. What is job order costing? Job order costing is a method to calculate the manufacturing cost of each production. And why the job order costing is important is because one of the importance of the job order costing is to evaluate if the job order is profitable. By applying job order costing, the company can estimate the value of labor, materials, and overhead that will be spent on a single job. The other importance of the job order costing is to make decisions based on the data. The job order system is a valuable data because it stores the details and cost of a job. This database can be used as a factual data to evaluate the efficiency and reduce the cost by changing unnecessary process. So moving on to the next slide, which is the flow of job order costing. In the picture is a general model of cost flow. So basically, the basic flow costs in a job order system begin by recording the cost of material, labor, and manufacturing overhead. Direct material and direct labor costs are debited to the work in process account. Any indirect material or indirect labor costs are debited to the manufacturing overhead control account along with any other actual manufacturing overhead costs incurred during the period. Manufacturing overhead is applied to work in progress using the predetermined rate, which will be covered in the next slide. The offsetting credit entry is to the account manufacturing overhead control account. The cost of finished units is credited to work in process and debited to the finished goods inventory account. When units are sold, their costs are credited to finished goods and debited to cost of goods sold. The manufacturing overhead control account. Manufacturing of the manufacturing overhead is a temporary control account. Actual overhead costs are recorded on the debit side of the manufacturing overhead control account. Overhead costs applied to work in process using predetermined rates are recorded on the credit side of the account. Any discrepancy between overhead costs incurred and overhead costs applied shows up as a balance in the manufacturing overhead control account at the end of the period. A debit balance is called under apply overhead and a credit balance is called overhead over apply overhead. So the next slide is how to calculate predetermined rate. Predetermined overhead rate can be calculated by dividing estimated total manufacturing overhead cost over total amount of the allocation base. The allocation base is basically a direct labor hours or machine hours. That's all for me. Thank you.
Hello there, good day to you. I am Abraham, son of Emil Peter Lutz. My matrix number is BK17160266 and today I am in charge of presenting on process costing for the subject Management and Accounting for Engineers. Alright, first and foremost, what is process costing? Process costing is technically the cost that is required for operation purpose. Now it can include anything from the cost of the final product, from the cost of the material used, and it's mostly done for companies which produce large quantities. Alright, now I'm going to explain about the methods involved in process costing. Now, the first and foremost method is inventory analysis. In inventory analysis, we will evaluate the cost flow of the inventory within the business. The cost for each process is then determined, and the cost that is determined is closely related to the production cycle. From there, we will calculate the opening balance of the inventory, what was produced during the period, and what is left in the work in progress. Moving on, the work in progress value is equivalent to units. Therefore, the next step is to convert in process inventory in the opening balance to equivalent units. For example, if we had 100 items in process at 60% completion, we consider these equal to 60 entirely produced units. Moving on, the total cost is then calculated. Whatever cost that is incurred throughout the process, the development of that particular product, it is calculated. And these costs, including the cost of work in progress inventory at the beginning and also at the middle of the work. We apply all of these costs over the inventory produced, and then from there, the total cost is calculated. Next, cost per unit is later on determined. Now, what happens here is that when we have all the cost for producing the complete final product, we divide it over the finished items, in which the number of the finished item is used to be divided by the total cost. From here, the cost that is produced, okay, will then be used to complete the in-process units, whereby the cost is then split between finished goods and work in process, in which the cost per unit and the respective unit volumes is then calculated and determined. Alright, moving on. I would like to now explain on the advantages that are present in process costing. Now, the first and most important advantage of process costing is that process costing helps to determine costs which is present in each process, and also costs which is going to eventually lead towards the production of the final product. Now, if the overhead rates are predetermined, unit costs can be computed very promptly, which can vary from a weekly basis and also monthly basis. Okay, since customers' demand may vary and costs, when we are talking about costs, it can range from anything to cheap to expensive. All right, it is extremely vital to have a standardized process so that the final cost, okay, the final cost or the final quotation required in order to produce the product can be easily determined or approximated. All right, and moving on, price quotations also can be suggested or submitted to the clienteles with standardization of process, in the sense that when a rough approximation is given, the client can actually use that rough approximation to decide on whether they would like to still continue doing business with these companies or not. Next, in comparison to job costing, it involves less clerical work, and apart from that, cost finding is also simple, less expensive, and can be easily determined. Next, the allocation for each expenses can be easily determined, and the cost that is incurred in each of the process can also be easily determined. So, this particular standardization of costs can actually contribute a lot in standard costing of system, in which we can very easily determine the process costing even before we start with the process, or even before we start designing the product. Last but not least, all right, the performance analysis and managerial control is facilitated to a greater extent, whereby the availability of cost data in the form of prompt and accurate cost reports is required in order for proper costing and in order for plans of actually reducing the expenses involved in costs, so that the profit margin can be increased. So these are the advantages of process costing. Thank you.
Hello, my name is Daniel Aaron Dublin. and I'm going to present on the net present value method, which is known as the NPV value in the capital budgeting. So basically, the NPV is the difference between an investment's market value and its cost. Or in other words, NPV is a measure of how much value is created or added today by undertaking an investment, which will determine whether or not the project is an acceptable investment. So in this slide, it shows that the formula of NPV equal to sum of PV, which is the N represent the project class in time given. The CT is the cash flow in time period T, and K is the required rate of return. And basically, NPV can be summarized into three conditions as being shown in this table. First, if the NPV value is positive, then the project is acceptable since it promises a return greater than the required rate of return. The second condition is when the NPV value is zero. It is also acceptable since it promises a return equal to the required rate of return. And last but not least, if the NPV value is negative, the project is not acceptable since the promises a return less than the required rate of return.
Assalamualaikum. My name is Muhammad Rosmin bin Rusli, and I will present the capital budget and the internal rate of return. So, capital budget. So, what is capital budget? So, capital budget is the process of assessing investment and large expense in order to maximize return on investment. So, what the objective of the capital budget? So the first objective is to selecting the profitable project. So throughout the course of company's existence, it's encounter a variety of profitable projects. So, however, due to capital constraint, an organization must select the right mix of profitable projects. So the next is capital expenditure control. So this objective is to control the capital cost. So next is to finding the right source of fund. So this objective is to strike a balance between borrowing cost and investment return. So the next is capital budgeting process. So the first process is identifying investment opportunity, and next is to evaluation of all investment proposal. Then choosing the most profitable investment, and then capital budgeting and apportionment. And the last one is the performance review. So there are few techniques in capital budget, and one of them is net present value and the internal rate of return. So I will present the internal rate of return. So internal rate of return. The definition of the internal rate of return is annualized effective compound return rate. So this is internal rate of return is annualized effective compound return rate of all cash flow from a specific investment. In other words, the IRR of an investment is the discount rate at which the net present value of the investment cost equal to the NPV of the investment benefits. So the purpose of this internal rate of return is it acts as indicator of the efficiency, quality, or yield of an investment. So it's different with net present value, which is an indicator of the value of an investment. So an investment is then acceptable if its internal rate of return exceeds a predetermined minimum acceptable rate of return of capital. So this is the formula of internal rate of returns. NPV, where NPV is the net present value. The n is the total number of period. The small n means the period, and Cn is means the cash flow, and R is the internal rate of return. So that's all from me. Thank you.